All right, friends, let's get started. Happy to be here today. My name is Dan Packard, and I'm here with my partner, Colton Williams, to discuss the recent inaction of the Big Beautiful Tax Bill. A lot of important provisions here. I think it's probably one of the most wide-reaching and comprehensive tax bills we've seen for quite some time, Colton. So a lot to discuss today.
Yeah.
I would say that you're going to see some things that feel familiar. I'd say, we have certainly aspects of the former Tax Cuts and Jobs Act that we see kind of receiving a second life, as well as some new provisions that are entirely new, things that we need to get a bit more familiar with. So excited to kind of talk through that with the whole team today. We look forward to your feedback. So to the extent that you have any thoughts or recommendations on how we can make these better in the future, feel free to reach out to myself and Colton. We'd be happy to accept your feedback here. The bill is one that kind of got its life initially starting in May. The House had passed the bill HR 1 that the Senate then subsequently voted it on. And we saw a final passage of this bill in July. It's fair to say, though, that we've seen attempts at tax legislation in the past. Colton, is that fair to say?
That's true. Some of you may recall there was a bill last January of 24, called the Tax Relief for American Families and Workers Act of 2024. It passed the House. It had a lot of these provisions in there, as well as others that didn't make it. But it's definitely something that Congress has been working on, doing some tax reform, extending some of the Tax Cuts and Jobs Act provisions, like you mentioned. But really, this is what they finally got through.
Excellent. As I mentioned earlier, there are certain provisions here that are really extensions of the Tax Cuts and Jobs Act back from 2017, 2018, and others that are new provisions. I thought it'd be helpful if we maybe start by talking about things that maybe we're a little bit more familiar with, and then maybe go into the areas that we're less familiar.
Yeah, that sounds great. And one thing to add, there's also some things that got cut. So not only extensions or new things, but there were some things stripped away to kind of pay for some of the new provisions or the extended provisions.
Well said. Thought we'd start with maybe some of the easier things here. First of all, individual income tax rates. We've enjoyed modified rates. I recall when the top individual tax rate was 39.6%, but it's been long enough now that I think it's been at 37% for nearly 8-9 years now at this point. So seeing now the permanent inaction of modified tax rates at the 10, 12, 22, 24% tax rate, I think is meaningful, I think, to many taxpayers.
Yeah, especially when you're looking at long-term planning. It's one thing to reduce taxes one year, but to be strategic over several years to take advantage of the tax brackets and tax rates. This just gives clients stability, not only in the rates. There's other provisions too that we'll see that do the same thing, that make long-term planning more stable, less unpredictable if things are going to expire or what. It's not to say that it can't change, but at least now under current law, there's stability. Not everything is a temporary provision that has an expiration date.
Well said. Obviously this is a point of tax planning, but I think it's helpful for people to see these rates are not very well spaced from one another. We have a 10 and a 12% bracket that jumps very quickly to a 22, and then to a 24, a small gain, 24 to 32. So these sizable gaps and understanding where those thresholds are certainly helpful from a tax planning standpoint. And the fact that we now have these in permanence, I think helps us plan not only for the current year, but really for many years to come, over what we can anticipate to be those marginal inflationary adjustments.
Yeah, I agree.
We're also seeing an extension of the child tax credit. This has been at $2,000. I recall back when it was about $1,000 per child, but we're now seeing it at $2,000. This jump was really in response to the fact that we saw personal exemptions, dependency exemptions going away from individual income tax returns. So in lieu of those amounts, we saw an enhanced child tax credit. We're going to see this credit go from $2,000 all the way up to $2,200. As well as the refundable portions being enhanced as well too.
Yeah.
The short of it here, more money for taxpayers, right?
That's right. One thing we didn't include on the slide is the other dependent credit, which, it is similar. However, that one, it's staying at $500 per qualifying dependent. It's not adjusted for inflation, and it's not being expanded. So there may be some some taxpayers that, they have children and they may have other dependents, older children that still reside with them. That is something that we didn't see change, like we did the child tax credit.
Right. No, good. All I think helpful, obviously, for taxpayers that want to plan around this. Can taxpayers expect there still to be a phase out of this credit as well, too, for high income tax earners as well?
Yes, that's true. The phase out range is similar to where it's at now. And so they're still planning around that for the higher income earners, but it's definitely a good thing to see it extended and not revert back down to that $1,000 credit.
A long time ago, during Trump's first window in office, he had mentioned his intent to simplify the tax code. And his response or his solution for that was expanding the standard deduction. At the time, I recall for married filing joint individuals, it was $12,000, $14,000. It was pretty low. And just as a reminder for our viewers, taxpayers have the opportunity of either enjoying a standard deduction based on their filing status. If they're individuals, they'll get just a certain amount that reduces their taxable income. Married filing joint individuals get about double that amount. But in Trump's effort to really simplify the tax law, he thought an appropriate response would be, well, we'll just expand the number of taxpayers that don't have to itemize their deductions. And so in response to that, we saw many individuals, enjoying $25,000, $30,000 married filing joint standard deductions, no longer requiring them to itemize their deductions. It's just at that point, their charitable contributions, their state income taxes, which under his law were hobbled. I mean, we're talking about a $10,000 cap on deductible state income taxes. But the sum of their medical expenses, their mortgage interest, their charitable contributions just wouldn't prevail beyond the standard deduction, inherently simplifying the tax law. I think we're seeing further efforts on his part to simplify the tax law and make those simplifications more permanent.
Yeah, for sure. The other things that add to the itemized deductions is mortgage interest, which, we'll look at that in a minute, but there's a cap on that was placed back when this changed. So not only SALT limitations, mortgage limitations, it's definitely created a lot of simplicity for a lot of taxpayers, but also other planning opportunities for people that may do bunching strategies, or the SALT cap has the pass-through entity deduction that all these things kind of were born out of the standard deduction being doubled because it changed the strategy. It changed what people could do or could benefit from. So it's good to see that this is extended. It definitely will keep it simple for a lot of taxpayers going forward.
Certainly. Obviously, a need for us to pivot our strategies, like you've said, but with a permanent, placeholder for our standard deductions being at enhanced amounts, namely for single individuals, $15,750, married filing joint, $31,500. Having these in place that will be indexed for inflation, I think that predictability is going to be helpful. Now, you mentioned modifications and changes to mortgage interest. Do you want to maybe get us up to speed on what has changed or stayed the same here in this space?
Yeah, it used to be that mortgage interest, whether that was on your first mortgage or a home equity line of credit, that mortgage interest was all deductible. There was no cap on the amount of the loan or things like that. But we saw with the Tax Cuts and Jobs Act of 2017, they started to put limits on that, saying, okay, it has to be, it's just 750,000. There are some exceptions there if it's an older loan, but the home equity line of credits, that was only deductible if it was used to improve your home. You couldn't, pay for a vacation or something like that, a new car, if on your HELOC. Those provisions were extended. There's still that 750 cap on interest being deductible. The one thing that did come out of this that's new is the mortgage insurance premiums. That's something that used to be deductible. It was made non-deductible, and now it's back. And so for those that have mortgage insurance on their on their homes, that will now be deductible in addition to their mortgage interest.
Very helpful. I've noticed with my clients, the takeaway here, when we speak of this limitation, the $750,000 limitation, it's that the deductibility of their mortgage interest as an itemized deduction phases out the more that balance, that outstanding loan balance is in excess of $750,000. There was a time where this felt like it would only apply to a few taxpayers. Anymore, it's feeling like every other taxpayer where I'm bumping into this limitation.
Yeah, it definitely has come into play more over the last couple of years, where home prices have gone up and people have been getting larger loans to afford that. So it's definitely something that will continue to be in play, as this is one of the thresholds that is not indexed with inflation. It's just a set 750. So we'll see, the next time a tax bill comes through and maybe adjust that. If not, it's just one of those things that's kind of arbitrary at 750, not subject to inflation.
So this is probably a good time for us to clarify the distinction between a provision being temporary versus permanent.
Mm-hmm.
Temporary billing being that the bill outlines an expiration date, a time that it will revert back to some predetermined amount, right? The Tax Cuts and Jobs Act, that we initially saw 8, 9 years ago had a lot of temporary provisions in it. They had expiration dates that were in 2025 and 2026, some even earlier than that as well. When a provision is made permanent, it's effectively like an indefinite period over which this will be in place. So when we say this $750,000 limitation is permanent, barring there being some further tax legislation, this is what we rely on.
Exactly. Yeah, and that's one thing we'll notice throughout all these slides is there's different enactment dates or dates they become effective. Some are already effective, some will be the next few months, some over the next couple of years it'll become effective. The other thing to look for is a lot of these are permanent, but some of these are still temporary. There's still some of these provisions that have an expiration date that will need some other legislation to extend them, or it's just going to revert back to what it was previously.
Well said. Give me just one moment here, Colton. Oh, here we go. Let's go back 5 slides here. Okay, we've talked about the SALT limitation. Now, this is state and local taxes. That's what that acronym stands for, SALT limitations or SALT deductions. Most taxpayers listening are going to remember or know that the amount of their state income taxes that's deductible on their individual income tax return as an itemized deduction has been capped at $10,000. This hasn't been indexed, it hasn't been moved, it's been 10K for a minute. And this limitation has caused a lot of self-employed individuals to rely on other tax strategies that we'll talk a little bit more about, but other tax strategies to try to bridge a gap here or try to surrogate this deduction the best they can. We're now seeing the Fed responding to, I think, what was a very overall negative response to this SALT limitation that we had in the past. States like Idaho, I mean, comparatively, Colton, we have a pretty high state income tax. California, these other places as well. There's a lot of pushback from us, and I think we see a positive response to that. What are you seeing the Fed kind of do with this bill that you feel is addressing that concern?
Well, I think it's definitely a debate between states. Like you mentioned, there's some high income states that this drastically impacts their tax base. Other states, that don't have a state income tax, they could care less about this. So really, it's a battle between different states getting deductions for their residents, right? Idaho, like you said, is kind of in the middle, maybe on the high end when we look at taxes with no state income tax, but really it's just a balancing act of who gets deductions. With the expansion of going up to 40,000, it's definitely going to allow a lot more taxpayers to not have that limit come into place. But as you know, as we've mentioned, this is one of the temporary provisions that it is only for the next few years. In 2029, that's the year it expires, and in 2030, we go back to the $10,000 limit. So definitely, it'll be interesting to see what happens if this gets extended. It's, like I mentioned, the big proponents of this are the states with the higher income taxes.
Certainly. I think we might see some modification in how people are approaching their state income taxes. It may be that fewer business owners are paying it through their business, maybe not, depending on whether or not they're itemizing.
Mm-hmm.
But this is certainly something that I'm grateful to see come through. I think this, again, simplifies things quite a bit. It doesn't require taxpayers to have to be overly strategic about trying to find ways to deduct that.
One thing I will note on that is, while this does help, states with higher income taxes, it also limits it to high income earner, or reduces the deductibility for high income earners. Once you get to 600,000 AGI, that starts to phase out back to that $10,000 threshold. So it's definitely one of those things that's going to help people, but for those with high income, it's still, you could be looking at still a cap of 10,000 depending on what your income is. So there might be, for those clients that are close to that threshold, you might try to time things between years to try to keep within that deductibility window so that you make the best out of that 40,000 limit.
Well said. One provision here, Colton, I didn't like was modifications to charitable deductions, deductibility as itemized deductions. This imposition of a 0.5% floor on charitable contributions, I don't see being overly popular. An example here would be that, you have to prevail beyond, I believe, is it 0.5% of your AGI before you're able to deduct anything. So
That's correct.
I mean, to the extent that, let's say someone has, I don't know, $100,000 AGI, the first $500 of their charitable contributions are non-deductible in that instance. Is that right?
That's correct.
If we're itemizing.
It's definitely one of those things where, the tax law has incentivized charitable donations. Now it's, this is a minor item that is kind of saying, hey, thanks for donating, but we're not going to allow you to deduct it.
For that first bit there.
Yep.
It seems to almost be favoring those that are going to be utilizing the standard deduction. The second bullet point here is a unique one because supposing you're not itemizing and unfortunately being subject to this 0.5% floor on charitable contributions, if you're using the standard deduction without any limitation, the first 1,000 to 2,000, if you're married, filing joint, of charitable contributions are deductible above the line, I believe. Is that right?
That's correct. It's something we saw during COVID. I can't remember if it was 2021 or 2020.
I remember that.
One of those years you could deduct, I believe it was 300 or 600 if you're married filing joint. So it's similar to that. It's more, which is good, but I think you're right. We're definitely going to see less people itemize and see if we can make good tax strategies by just using the standard deduction.
Yeah, it's a unique play. I can't imagine how this was an overly strategic move from a revenue generation standpoint, but I'm not a lawmaker.
Yeah.
Something that's always been kind of a confusing point for taxpayers and CPAs alike as well too. I'll add the AMT, aka the alternative minimum tax. Jokes amongst us CBAs has always been it should be called the alternative maximum tax because it seems to just ensure that you pay a certain amount of tax. That being said, though, we're seeing an extension of provisions that allow most high income earners or most taxpayers just to avoid this tax altogether. I don't think it's wise for us to get into too many of the nuances here. I think the takeaway here ultimately is that we have seen a huge reprieve of taxpayers having to encounter this tax. That's going to continue going forward.
Honestly, I think it's just more of a CPA thing. It helps us, simplify a little bit. So definitely helps taxpayers, but definitely simplifies the overall return for those that may have been subject to this tax.
Agreed. Something that's been huge. And Colton, I think you and I were talking a little bit about this a couple days ago. Estate taxes have been elusive, not because they're necessarily difficult to understand, it's that they're difficult to predict. If you looked at the last 25 years of how much estate tax law has changed, it's been radical. I mean, we're talking about instances where the lifetime exclusion has been as low as $500,000 and as high as an unlimited exemption, albeit for a very short amount of time. The point being is that this is an area of just radical change. So imposition of some permanent, you'll notice the word bolded there, permanent, some imposition of some permanent provisions here, I think are going to be very, very helpful. Maybe you can familiarize us a little bit of what we can maybe predict around it.
Yeah. Like you mentioned, it's been hard for high net worth individuals to strategize or have a long-term plan for gifting, or just their estate tax overall on when to gift or how, or things like that. And so having stability, it'll be able to help clients just feel good about the decision they're making, because in times past you may have gifted when the exemption was low, hedging, saying, hey, I'm doing the right thing to move my estate to the next generation, when 2 years down the road, all of a sudden the estate exemption is doubled, right? And so all that gifting was kind of pointless. You could have just had your estate transition to the next generation without any tax. And so having this be made permanent, it will give stability to that environment to really have taxpayers make good educated decisions that hopefully will remain. Like we've mentioned a couple times, unless Congress changes the laws again with another bill, this is set to be permanent and will give us stability.
Yeah.
So
Two thoughts there on that. The first one being is that the highly mercurial nature of this tax provision over the last 25 years is because all the provisions were always temporary. They were always set to expire at some point. By making this permanent, again, I think it lends a lot of predictability, like you've said, for taxpayers to plan around. I think there might be an initial inclination for people to say, well, this means that we're going to see less estate planning. I disagree. I think we're going to see more of it because people actually have a roadmap to work with. There has always been this promise of, well, maybe when I pass the estate tax laws will be more favorable. Therefore, I'm not going to plan. Therefore, I'm going to kind of roll the dice and hope that, I would not have needed to plan, right? I think by saying this is permanent, you can make clear stock of what your current net worth is, and then make strategic moves that accommodate whatever level that's at.
Yeah, and I don't know if we mentioned this is adjusted for inflation. So, we're starting at 15 million per person now, 30 million for married filing joint, but that will be indexed. So, just again, giving us more stability, knowing what it will be in the future, and that, as your estate grows, it may be that the inflation rate keeps you under that threshold as well. So definitely good things there.
Agreed. One moment here, Colton. It's being sleepy again. Okay. The next item that we wanted to talk about was 529 plans. Just as a reminder, everyone, these are college savings plans. They are generally state deductible when contributions are made to these accounts, and are tax advantaged, generally coming out as well too. The money historically has been pretty limited. There's been a requirement to use it for qualified purposes, which I'll be honest, has even created in me maybe some hesitation in utilizing these strategies, not only for myself, but also clients as well. I think that this bill intends to widen applicability. Is that fair to say?
That's definitely been the direction that 529s have been going over the years. It used to just be used for college expenses. Then it was expanded to K through 12 tuition expenses and things like that. And this adds to now post-secondary credentialing expenses. The AICPA, the Accounting Society, they were posting how now aspiring CPAs can use 529 funds to pay for their CPA courses and things like that. And that's going to be applicable to other fields of engineers or nurses, doctors, things like that, that these funds will now be available. I'm with you. You mentioned the hesitation to advise clients on that. What do you do if you put away a bunch of money and your kids don't go to college, right? Even this bill doesn't address it, but there have been changes in the last couple of years to allow those funds to convert to retirement funds, to an IRA or something like that. So definitely been some expansion in this area.
I think you've described next level CPA nerddom, someone that sets up a 529 plan to pay for his study materials for the exam.
Yeah.
But to your point, I mean, we have a lot of taxpayers that are, involved in post-secondary and postgraduate even work to credential, be that in the medical field, in the education field. So applicability with this may widen its use maybe a bit more. Anyway, I'm glad they've made the moves. I think there's probably still work to be done in that space. nonetheless.
Yeah.
Colton, so we've talked about the things that kind of rhyme, things that we've heard about in the past. Is probably now leaning a little bit more into these are newer provisions, things that we might be a bit more unfamiliar with that are now part of the credit, but we've heard a lot about.
Yes, a lot of these have been the things that Trump campaigned upon. We'll look at overtime, tips, Social Security not being taxable. We'll see how those all ended up in this bill.
I was going to say, why don't we start with the overtime one? Because that was one of those campaign trail promises that caught a lot of attention, right? I think the message there being, your working class individual that's accruing overtime, we're not going to burden you with taxation on that. Of course, the details are always far more nuanced than, or in action, always a little less attractive than the promises, right? But maybe familiarize us a little bit with what we thought we were going to get and maybe what this is now, and in practice, maybe what administrative burden this might add to us.
Yeah, I remember hearing this and people asking me, "Oh, that's great. That means no tax at all on this overtime." Well, there's still guidance that needs to be released on what exactly will be exempt. But what we know now is Social Security taxes like Medicare, Medicaid, those type of taxes, FICA, those terms, those still all apply. You're still going to be paying those taxes on the overtime. There's even been some debate on income tax. This is what Trump was really saying, is that it would be income tax exempt. There'd be a deduction that you would get for the overtime pay. Now, some have said any overtime hours would be exempt. There's been other people I've heard say, well, it's not the all of the overtime pay, it's just the incremental amount. If you're being paid time and a half or double overtime, it's just that extra half, or that that double pay that is exempt. Your base wages are still going to be taxed. And so it'll be interesting to see what actually comes out of this, and how it's reported. It's likely that there'll be a field on the W-2 or something like that will show the applicable amounts. And so that's great for taxpayers that'll have that field, but it also means additional compliance work for business owners.
It does.
To track overtime and how much is that exempt amount.
Well said. I mean, that's immediately where my mind went as I thought to myself, this is creating additional burden for business owners that now have to, they've already been tracking it, I'm sure, but the reporting of that in a more formalized way on a W-2, on a W-3, likely, on other reporting forms as well too. This is going to lend some burden to taxpayers, but again, a benefit to individuals that will, be able to claim some exemption from that overtime amount.
Yeah. One quick thing on the overtime is there is a cap. It's not unlimited. Overtime will be exempt. It's 12,500 for single individuals, 25,000 for married filing joint. One other thing I've been asking clients now, how do you compensate your employees? Are they all salary? Are they hourly? Just to kind of get a pulse of how many businesses this will affect. And even to the extent of people like firemen or police officers, where, they may be hourly or salaried, or, it's like they have unique hours and things like that. So I'm wondering if, how that will be addressed, because there's definitely a lot of different compensation models, and I wonder if this will kind of shift incentives for employers on how they pay their employees.
Well said. We use this very generic term of art, overtime, right? But I mean that really only bears applicability when you're talking about your most basic compensation models. You're absolutely right. I mean, we see this with fire departments, police officers. Their compensation models are hour tracking, entirely unique and different, that I'm sure this bill needs clarification on. Hence, I think why you're reminding us, we've been promised more information on this that we're probably going to need. Right.
To add to that, there's some industries or employee types that are exempt from overtime. A lot of ag workers. Ag workers don't get paid overtime, or truckers, they may be paid on a per load basis. So is there going to be some kind of computation to say, hey, I worked so many hours, but I was paid, by the load or something? It's still to be seen. That it's probably going to be something pretty, I don't know, simplistic, that will probably require some interpretation on how to adequately apply it.
So for those of us, present today listening that have those unique comp models, the message to them really today is we hope to receive additional clarification and guidance.
Right.
And it's likely to come through many of their industry leads as well, too. Maybe a lot of their thought leaders in each of their respective spaces that will provide some good guidance. Let's talk a little bit about tips as well, too. This was another one of those campaign promises discussed, the removing income tax as it relates to tip income as well, too. Is it very similar to overtime here, its applicability?
It's very similar. There's going to be a deduction for it. This is also has a cap and has an income phase out. It's not something that everyone will be eligible for. If you have high income, you'll see a phase out for that.
Got it. So we do already have some kind of unique boxes already on the W-2s that address the amount of pay that is tip pay. So it may be that the compliance component of this will be a bit lightened compared to the overtime compliance.
That's correct.
Okay, good deal. This one was really unique for me. We see a boon of interest rates. Rates are up right now. I was just recently talking to a family member about, should I finance the car I'm buying or should I pay cash for it? And this kind of helps that answer just a smidge, right? I mean, of course, we never want to incur a cost merely for its tax deductibility. But if we're talking about, the market is performing at a certain level and I have the option of being able to deduct some of my auto interest, this may be, I think, quite meaningful to certain people that are listening today.
Yeah, I agree. I've had a lot of people ask me, hey, should I buy a pickup now? Or, I can finance it and deduct it. Well, if you're a business owner and it's a business vehicle, you're already warranted that deduction. It's really for personal vehicles that this comes into play. And, there are nuances to this. It has to be assembled in US.
And a new car.
And a new car, yeah. So you can't go buy a used or a foreign car. It has to be new, assembled in the U.S. And it kind of counters. I know we have another slide here about EV credits and things like that. It's almost a swing in the other direction, saying, hey, we don't necessarily want subsidized EVs. We're looking for U.S. vehicles. It's
Right.
not more a broader approach than a specific car type.
Yeah, this one's a unique one for me because their target individuals are people that have modified adjusted gross income, or let's just say income of 200,000 or less, or single individuals with 100,000 or less. They need to be acquiring a brand new car, and we're capping the deduction at $10,000 as well. It's a unique fact pattern here. I know we would probably initially think, wow, this is going to have wide applicability for taxpayers. To your point, I think this is going to impact fewer taxpayers than we think.
Yeah.
There is, I mentioned earlier in our slide presentation, Colton, this personal exemption. Long ago, back when you were a child, there was this thing called personal exemptions, okay, or taxpayer exemptions. Back then, married filing joint individuals and for children, they were given deductions, for all of the dependents and for themselves that they claimed on their income tax return. And I mentioned to you, the child tax credit was enhanced kind of in response to them taking those exemptions away. We've had people always within the tax law, both on the federal and the state level, there was always incentives built in for those individuals. That's Social Security, for example, that receives favorable taxation. That's an enhanced deduction for IRA contributions or for HSA contributions. They've always been a target of I'm going to say tax advantage. This is, I think, a furthering of that, where we need to think back to how things used to be, 10 years ago when we had personal exemptions. And we need to also remind ourselves, yes, seniors have been given enhanced standard deductions in the past. This, I think, is an effort maybe to clarify that and make it more widely applicable to seniors.
Yeah, this was definitely related to a campaign promise Trump made to have Social Security non-taxable. It didn't get there. Social Security still is taxable. But if you're over 65, it's a $6,000 deduction. And so if you're married, that's 12,000, depending on how much your Social Security is, for some, that may cover a good portion of it. And like you mentioned, it is on top of the deductions that seniors already get. If you're a single individual over 65, you get an additional $2,000 deduction. So it really, if you're comparing your income deductions from age 64 to age 65, all of a sudden you get $8,000 of additional deduction between what's already in place plus this additional 6,000. Definitely going to help those seniors.
In that space. I agree. I think, again, like you said, the campaign promise was effectively to lighten the tax burden of seniors. This, I believe, is a very concerted attempt to do it. And in very, very simple terms, the takeaway is individuals 65 and older are going to enjoy, at a minimum, this additional $6,000 exemption, reduction of their taxable income.
Yeah, and one thing that you mentioned that there are favorable treatments on some states. Some states already don't tax Social Security, so it'll be interesting to see how the state responds on this, as well as the other issues we've talked about. No tax on tips, overtime.
Mhm.
Those are likely still going to be taxable to state agencies.
Yeah.
So again, it creates a lot of compliance headache there, but ultimately there are going to be tax savings for a lot of individuals. It'll just be interesting to see how states adopt and react to a lot of these changes.
Well said. I mean, conceptually, and even from a taxation standpoint, as states and the Fed continue to gain in disparity, we're going to see, like you've said, yeah, these are all federal incentives. They very well may not be state incentives. And add backs and adjustments for the states on whether or not they comply with this is going to be a state to state thing that we're going to have to track. Why don't we go ahead and move on to some business tax provisions? These seem to be the ones that catch most of the news, at least, as it relates to, depreciation changes, or, incentivizing individuals to make domestic investment into their businesses as well, too. Colin, I know the one that you and I probably most frequently talk about is depreciation. And namely, this is the ability that a taxpayer has, a business owner really, to acquire a piece of equipment that ordinarily you'd be required to deduct over a certain statutory period of time, be that 5, 7, 15 years. There are provisions, namely bonus depreciation or Section 179, that allow us to elect to take those write-offs all today, speeding up that deduction, usually for strategic reasons. It makes sense. There might be reasons to spread it out, obviously, but bonus depreciation's had kind of a bit of a sordid past here for the last few years.
Yeah, it's been frustrating for clients, especially because if you operate on a cash basis financials or taxpayer, what you spend, you usually get to deduct. With depreciation phasing out from 100% over the last few years down to 80, 60, and it was set to be 40% this year, it's been challenging to see taxpayers say, well, hey, I spent all this money, I don't get to deduct it. Now going forward, they'll be able to kind of have the cash match up with the deductions that they have. This comes into play for new acquisitions of real estate, especially cost segregation, things like that. It had a couple clients call and say, hey, now with these changes, now a good time to buy more real estate, or things like that. So the answer is yes, you'll definitely get a bigger bang for your buck this year, but still worth the question of, is this acquisition still right for me right now? Don't just do it for the tax deduction, do it to make sure it makes sense.
Well said. I believe that, bonus depreciation plays a very pivotal role in a lot of the tax planning I do with clients. So I'm very, very excited to share with them the information that we have now, 100% bonus depreciation to play with. It's a permanent provision. So barring there being some further legislation, we're going to have this for a while. One thing that was weird about this for me is that it's for property acquired after the 19th of January.
Yeah.
So I would say I'm hoping most people are on holiday anyway during that time frame anyway, that they weren't making large acquisitions, but undoubtedly there's going to be a listener today that acquired something on the 15th of January that he or she wanted to write off 100% of and may not be given the opportunity to do.
Yeah, those dates, like we mentioned, the effective dates vary depending on the provision. This is one that sticks out with a unique date for sure.
Yeah, a weird one. In close concert with bonus depreciation is Section 179. This is usually utilized. I'm going to say it's prioritized over bonus depreciation because the states more often than not honor Section 179, and there's varied applicability or acceptance of bonus depreciation. It's a newer provision, right? So Section 179 is usually where we go first if we can. If business owners are making less than $4 million of capital outlay for equipment in a given year, this is where we're going to go generally. The good news is that they're expanding, doubling really the applicability of Section 179. It's also for things that are placed in service as of December 31, 24. So for that poor guy that acquired a piece of equipment on January 15th, we may still have applicability with Section 179.
That's right. I think the biggest takeaway is this nearly doubled, more than doubled.
Yeah.
And so I think like you mentioned, the question of should I take bonus or 179, it's going to favor 179 for most taxpayers now because of, the more than doubling of deduction.
Agreed. I think the takeaway for any business owner is that depreciation, enhanced depreciation, accelerated depreciation is here to stay. And that, from a planning standpoint, we don't need to be dealing with any phase out limitations. We're going to have a lot of latitude to make meaningful moves. Good year to tax plan.
Yeah.
One of the provisions, Colton, that I've never been a big fan of is the limited deductibility of interest, really for large taxpayers. We're not talking about really your average taxpayer. This is for large business owners that are incurring, maybe in certain years, very large operating losses. The deductibility of interest in that instance has been limited for a variety of reasons. I guess the takeaway with this slide is really it's here to stay. I mean, we're going to see more of this. Right?
It's here to stay, but there is some add backs, you could say, that help limit the amount that gets limited.
Super.
So like Dan mentioned, doesn't really apply to small taxpayers, and even some in certain industries like real estate or ag, there were elections that you could make that exempted you from this limitation. For those that were subject to this limitation, for the first couple of years, they were allowing for a depreciation and amortization add back, which most of the time, a lot of the losses taxpayers have are due to expansion. They're buying new equipment, more real estate, things like that. And with the accelerated depreciation, we're creating large losses, which unfortunately led to business limitations. Now with the add back for depreciation and amortization, I think we'll see less of the interest limitations that were created due to depreciation for growth and expansion go away. And so definitely favorable. It sucks that it has to stay, that there's still a limit, but it's definitely expanded where it's going to affect less people.
Well said. I mean, most of the operating losses that business owners have in any given year for tax purposes are by way of depreciation. So if we get to add those back in this computation, you're right. I think we're going to see very limited applicability of this limitation. That's exciting. There is a tax credit for business owners that are providing benefits for paid family and medical leave. It's a tax credit. I saw kind of widened applicability of this credit, maybe more towards the COVID era time frame as well. It seemed that was a very active conversation back then. I think the takeaway for me on this one is that, number one, permanent extension. So get used to it as a business owner. Make it part of the ongoing questions you're going to be asking of your tax preparer. Make sure that your payroll administrators are aware of these incentives as well, so that you can take advantage of these credits.
Yeah, I just reiterate, this is, a COVID era credit that is here to stay. This is something that the people have said they want. It's been beneficial for the retention efforts for employees, to have that flexibility to still get paid, when they have to care for a family member or take time off for themselves.
Agreed. This one has been one that I've bounced around a lot with. The research and development credit was, I'm sorry, I say development instead of experimental. You'll have to forgive me. But this R&D credit has been something that was very much in vogue, I'm going to say about 4 years ago. But because of some lapsed legislation, it became less of I feel like a strategic move for individuals. In fact, it almost felt punitive to some extent. The takeaway there is that for business owners that are engaging in, innovative activities, primarily labor-based credit, but innovative activities that improve a process, a procedure, things like that within their business, could afford themselves this credit. Now, I know I've described this in very general terms. This is a very nuanced credit with a lot of case law behind it. Primarily meaning that, its applicability to your business can be evaluated and can be determined. But really, because the lapse legislation didn't allow business owners the freedom to deduct the expenses that they identified as qualifying to claim the credit, more often than not, claiming the credit for the first few years cost them more tax than saved them tax.
Yeah, it was hard explaining that to taxpayers to say, hey, in the long run, you're benefiting, but it's going to hurt a little bit right now to pay a little bit more tax. And so this, as you've mentioned, kind of soothes that. It allows for expensing in the year those deductions are paid for, as well as a retroactive aspect of it, whether that's by amending returns or what's called a Section 481A adjustment, where you can essentially take into account the effects of going back and retroactively expensing those things and have them be deductible in the current year. So it'll be interesting. I'm waiting to see what guidance is produced by the IRS on this, on recommendations. As you may have mentioned, there is some different treatment depending on the size of the business you have. For large companies, over 31 million of gross receipts, I believe there's different requirements on how you're impacted. But for a lot of our small businesses, it's just going to be, you can go back and take those expenses or take them in the current year.
Got it. I think obviously this infers that the business owner claimed that credit, chose to amortize them, and now is being given the chance to go back and rectify that.
That's right.
For business owners that just disregarded this credit altogether, I think the takeaway is saying this is a good time to revisit the credit and evaluate its applicability to your tax strategy.
That's right.
Now we have, I think, one of the most popular provisions, my favorite provision of the Tax Cuts and Jobs Act from 8-9 years ago was the pass-through deduction. This is that 20% deduction that business owners get merely by being self-employed. The more I've evaluated it, Colton, the more I've learned that I think that this credit was really a response to the corporate rate going as low as it did.
It definitely was.
Yeah, it seems it really was a response to that. There was a lot of talk at the beginning of this year that this was going to go away. I was concerned for our taxpayers, our clients, that this provision, this tax strategy was going to be gone. And this has been a huge win for Idaho taxpayers here. So, or really taxpayers all around the nation. So the fact that this has been made permanent, I think, is a huge win for us. The fact that we're also seeing a widening of the phase out as well too is extremely helpful to professional service providers. Accountants, financial advisors, medical professionals. We're going to see a widened use of this credit under this new tax law than what we previously had.
Yeah, for sure. Like you mentioned, the specialty service trader business, there's still, you're still going to want to plan around getting this deduction, because as you mentioned, it phases out for some individuals. For others, it doesn't. If you're in one of those trades that you mentioned, there's still that nuance of, we need to plan to stay in that limit, because it can be a huge cliff to fall off of. All of a sudden you go from, the 24% effective rate to 33, or, it's something crazy, because not only do you increase tax brackets, but all of a sudden this deduction goes away.
It does. It's a very expensive deduction to lose, a very expensive tax incentive to forego. For our listeners that don't know what we're talking about when we say SSTB or phase out, it's likely they are the business owners that this doesn't apply to.
Yeah.
But for the medical professionals out there that have been trying very long to target this, the takeaway here is, hey, we've received a little bit of reprieve here. It's been widened a little bit more. It applies to a larger range of income, which is helpful. So we hope that we see more use of that for our professional service providers.
Yeah. One thing that was interesting as this went through legislation is there was talk of changing the percentage from 20% to 23%, and ultimately it stayed at 20. But it's interesting to see, the politics behind it, that ultimately they just ended up extending the current rates.
Agreed. We've got about 10 minutes left here, Colton, so we're going to go through these next items a bit quick here. But we've already talked about the SALT limitation. For business owners that have been deducting and paying their state income taxes at the entity level, the takeaway here is that remains intact. They're going to continue to do that. And the good news is that this is a permanent provision, correct? So while the SALT limitation on their itemized deductions remains,
subject
temporary,
to
subject to a cap and temporary, this is something that we're going to be able to utilize for a long time.
Yeah, definitely one of the best tools in the tool belt for CPAs to advise clients. I love this map that the AICPA has put out. It shows which states have no state income tax, and the ones in blue are the ones that have adopted a pass-through entity tax election. You'll notice there's a couple in orange which they have proposed, and there's a couple in white that, for whatever reason, there's a few states that don't want.
Nothing with
Yeah,
it.
they've done nothing with this. And one thing you'll know is there's actually a couple states that have passed laws, California, Illinois, Oregon, and Utah, but those are set to expire this year. So it'll be interesting to see, what happens for next year, to see if those states, now with the federal extension or permanency of these deductions, will follow suit.
I hope we just see extension of those provisions, but to your point, they may have a reason to say that they're not going to do it. I can't see why a state would feel incentivized to not provide it. I think this has increased state income tax compliance probably more than it has in the past. The prepayment of state income taxes as well too. I think this has been a positive thing in general for states.
Yeah.
So I hope we see that remain intact. We're going to see a continuation of the excess business loss reduction as well too. These are limitations placed on taxpayers for the amount of operating losses from businesses that they can claim in any given year. We see that continuing with this legislation as well. Just other key provisions I want to quickly touch on as well too. There are a few out there that are targeting a small business stock gain exclusion. These are C corporations that you sell. If you hold it for a certain period of time, if it's an accommodating business type as well too, and you follow a very narrow set of rules.
Yes, that's the thing I would point out. It's very narrow, those who qualify.
It is very narrow set of rules. Then you can afford yourself an exclusion of gain upon the sale of that equity. It's threading a needle though. I can count on one hand how many I've seen kind of happen.
I'm the same, just a few.
Yeah, we see the gain exclusion though going up to, I'm sorry, the eligible definition of a business going up to 75 million, where it's been at 50 million historically as well, and maybe a lessening of how long you have to hold on to this stock. It used to be you had to hold on to it was a cliff vesting at 5 years.
Yep.
You get excluded. Otherwise, if it's 1 day short of it, you don't get excluded any of it.
Right? Now you start having eligibility after 3 years.
That's right. So for those individuals that are kind of thinking about this strategy, something to bear in mind. We're seeing some clear guidance on 1099 forms, on instances where you need to be reporting for contractors that you engage. Those thresholds appear to be going up, Colton, that maybe is difficult to comply.
Yeah, for a lot of online businesses, you get a 1099-K from credit card processing companies or things like that. That is set to go to 600. Now it's going to be more at 20,000. So if you have 20,000 of income or excuse me, expenses, or 200 transactions, that triggers reporting for that. For the 1099 NEC or the MISCs, which most people are familiar with, there's been that low $600 threshold for contractors, things like that, it's honestly quite burdensome to track down that info for such a small amount. That's moving up to 2K, and being indexed for inflation. That's, I think, going to be a big thing going forward, because historically it's been a set $600.
Yeah.
Now it'll be indexed for inflation.
It's been at 600 for as long as I can remember. So the fact they're indexing it might be the best part of this as well too, that we're going to receive revised guidance on where that level lies. This one was weird for me, Colton. I mean, we're under the new bill, we're being told that they're phasing out, terminating a lot of the credits related to clean energy. So your EV cars and things of that nature, they're phasing out a lot of the credits related to acquisition of those cars. They're putting a drop dead date of 9/30/2025. So a couple months from now, right? That they're going to be saying any car acquired that is qualifying after that time frame, you'll no longer be able to claim the credit associated with it.
That's right. That's the one that's, I think, one of the closest effective dates is you have, 2 months to go buy an e-vehicle to claim this credit. Others, as you know, they're effective till June of next year, or some that end at the end of this year. And so it's definitely, if this is something you're looking at, meet with your advisor to see what and when qualify still, because there might be some things that you need to move fast on to take advantage of these.
Right. Other bullet points here are related to residential clean energy as well too. Again, all being set to expire by the end of 2025, some into 2026 as well. There's a few things here, Colton, we just didn't have time, and really probably the applicability to cover here. Trump accounts, gambling losses, moving expenses, casualty losses, adoption credits, some changes in ERC as well as some Medicaid and Medicare impacts as well too, all of which we'll probably find time to talk more about in the future. But we wanted to talk about what we felt would be the most wide-reaching ones today.
Yeah, there's definitely more info on some of these that could be shared. I've had people ask, "Hey, how does the Trump accounts affect me? I'm thinking about having a kid next year." And it's like, well, it's not going to happen until next year. More info will come then. So there's
That's right.
definitely things that you could still talk to people about, and like we mentioned, the next slide, it there's things that we need to remember here. There's not guidance on all of these yet. It'll be forthcoming. And, like we mentioned with the EV credits or things like that, the dates, you know, they vary. Some are already in effect, some are going to effect, some expire next year. That's key to remember and be on top of if you're a business owner or an individual taxpayer looking to take advantage of some of these things. Is you need to be careful on the dates. Pay close attention, as well as remember some of these are permanent, some of these are temporary, some of these are still set to expire. A lot of them were made permanent, but there's still some temporary ones out there.
Thank you, Colton. Very much appreciated chatting with you today, Colton, about these provisions. We're going to make available a recording of this presentation as well as a PDF of the slides to those that have been present. And if you have friends or others that you feel would be benefited by reviewing some of this content, we'd be happy to see that shared with them as well.
Yeah.
So with that, I'm going to thank everyone for their time. Thank you for spending this moment with us, and hope you have a great remainder of your day. Let us know if you have any questions, comments, or concerns, and we'll talk to you soon. Take care.